Hello everyone, Professor Savita Bodke over here. In the previous session, we have studied up to the fifth chapter of financial management. Now, this is the session number 2 of your financial management lecture series. I'm going to cover up today the chapter number 6. The chapter 6 is your cash budget. We have already studied this. Now, let's start with the MCQs. Holding the cash for the purposes which cannot be anticipated or the predicted is always termed as your precautionary motive. Now the next one, second MCQ, they have given you that the term deposits with the banks are marketable securities. Now the next one, they have given you the blank space and they have written over here that helps to forecast the future cash position of the firm. Always remember that your cash budget is helping you to forecast, means to estimate regarding the future cash position of the firm. Now the next MCQ is, in a cash budget, the closing cash balance of the one sub period becomes the opening cash balance of the next sub period. We have already studied the lots of the numericals based on this, and whatever the closing balance you are having for the particular month or for the particular period, that becomes the opening balance for the next period. Now the next one is the MCQ number 5. Cash held to protect against the uncertainties due to, correct answer is precautionary measure. Already we have studied this in the MCQ number 1 over here. Now the next one is cash balance is, and you are having all these options. Now think, what can be the answer over here? This is nothing but your current asset. We have already studied that whatever the cash balance you are having, that is your current asset. Now the next one is cash budget does not include, and it is depreciation. We never take the depreciation in the cash budget. Now please understand the reason if any college is going to ask you this question. This depreciation is a non-cash expense. That's why we are not going to include this in the cash budget. That is the actual reason behind this. Now the next one is, a cash budget is the summary of what we are doing in the calculation of cash budget. We are adding the receipts and we are subtracting the payments. So it is nothing but the summary of your receipts and payment. Now the ninth one, they have given you that blank space given over here, and they have asked you that shows the estimation of receipts and payment. The same question they have repressed over here, and the appropriate answer is cash budget. Now the next one is, cash held to meet the routine cash requirement is due to. Why we are holding the cash? We are holding the cash for the transaction motive. Now the next one is chapter number 7, that is working capital management. In case of the numericals, the practical part of this chapter, we have already studied that how you are going to calculate your working capital with the help of the simple formula, that is current assets minus current liabilities. Okay, so I'll just request to all of you that please study what is there in your current assets, what can be included in your current liabilities. Even that also can be asked by your college. Now the next one is, which of the following is the item of current asset, means which of the following is the current asset? Bank overdraft, whether that is the current asset? No, that is not the current asset, that is a current liability. Please remember the concept of your current asset and current liability. Current asset means the assets which we are holding for the short-term time duration, means that is up to the 1 year. And current liabilities means whatever the short-term liabilities we are having. Now bank overdraft, we have to pay to the bank within the certain time period for the bank overdraft. So that's why it is the current liability. Outstanding expenses is also the current liability. Your short-term loan taken is also the current liability, but the receivable, that is your asset, and that is the short-term asset. That's why it is the current asset. Now the next one is, which of the following factors influences the need of the working capital of the firm. Now, what is the working capital? Working capital means the capital which is required by the business to conduct the day-to-day activities of your normal business. So, what are the factors which influences the need of the working capital? They have given you the first option is the type of technology used. Yes, it is affecting on your working capital. Inflation, yes, inflation is also affecting on your working capital requirement. Nature of business is also affecting on your working capital requirement. So the appropriate answer is all of the above. Now the next one, that is the third question. The single most important ratio in case of the working capital management, that is your current ratio. Please remember that, which is the important ratio, that is your current ratio. Now the next one is working capital source of finance is a short term source, because only for the short term period we require this working capital, because working capital is nothing but the capital required to conduct the day to day activities. So the purpose, or it is the source of your short term finance. Now the next one is read the following statements. Now they have given you this statements over here, but I'll advise the students that please skip this part, because this is not that much important from your MCQ based examination. Now I'll move on to the next one, that is financial statement analysis, that is your chapter number 8. Now they have given you the first question over here, that the prime cost is also termed as, please remember that the prime cost is also termed as your direct cost. Now the next one is balance sheet tallies because means the debit side is also same as your credit side. Why? Because it is based on the double entry system of the accounts. So that's why we always tally your balance sheet. And if your balance sheet is not going to tally, it means that there is some error in your balance sheet. Now the next one is third one. Inventories are also termed as the stock. Now the next one is which of the following is an item of your current liability? Now, please check out this and tell me the answer for the fourth one. Yes, that is correct. We have already discussed that. That is nothing but your bank overdraft, because your bank balance and cash balance is your asset. This is your current asset. Unsecured loans is not your current liability. That is the part of your loan. But bank overdraft is your current liability. Now the next one, the fifth question they have asked you, that the ideal current ratio must be. Always remember that the ideal current ratio must be 2:1. This you have to remember little bit. Now the next one is in the balance sheet, dash stock is indicated. So in the balance sheet, always remember that the closing stock they will put. There is opening stock is in the trading account, but in case of the balance sheet, always there is the closing stock. Now the seventh one, they have asked you that a dash tallies on its own, that is your balance sheet. Now the next one is a goodwill is the example of intangible asset. Intangible asset means the assets which we cannot see, but the goodwill plays a very important role, and goodwill is nothing but your reputation. Now the next one, I'll move on to the chapter number 9, that is introduction to costing. Now again, there is a repetition over here for this first question. The prime cost is also termed as your direct cost. Now the next one is the second question. They have asked you that the direct costing is also termed as your marginal costing. Now the third question is a semi-variable cost is the type of the cost classification based on. Now we have already studied this so many times, that is nothing but on the basis of the variability. Now the next one is the fourth one. The aggregate of all direct cost is termed as, and what it terms at? It terms as your prime cost. Now the next one, that is the fifth one. The cost which remains unaffected even though there is a change in the level of the output means the cost which is always fixed. That is nothing but, yes, your guess is correct. That is fixed cost. Now the next one, the sixth one, they have asked you that a cotton used in the textile mill is the example of, and what can be the correct answer over here? Whether that is the direct cost, indirect cost, total cost, overheads. Just think and just tell me the answer. The appropriate answer is, it is the example of your total cost. Now the next one is discount on the goods sold. The discount on the goods sold is, whether that is the selling cost, distribution cost, finance cost, or none of the above. Actual answer is, it is the finance cost. Now the next one is the production administration and selling and distribution cost is the classification of cost on the basis of, it is on the basis of the behavior. Now the next one is, as the units manufactured increases, the fixed cost per unit is going to be increase or the decrease? It is going to be decreases. Now the next one is, as the units manufactured decreases, the total fixed cost remains constant, because the fixed cost is the cost which is always constant. Okay, means that expenses are not going to be changed at all. And here we are on the last chapter of your financial management, that is marginal costing. Again, we are having the first MCQ over here, that again it is the repetition. Direct costing is also termed as marginal costing. CPU stands for, this is not the CPU of your computer. Please remember that CPU in your financial management, it is cost profit unit. Now the next one is the third question. The aggregate of dash cost is termed as the overhead. The aggregate of total cost is termed as the overheads. Now the next one is the fourth one. In the break-even chart, dash is indicated. We have studied regarding the break-even chart. So what we have included in this break-even chart, profit area is there, margin of safety is there, even the break-even point is there. So the appropriate answer is all of the above. Now the fifth question is, BEP is also termed as, it is termed as no profit, no loss point, because break even point means whatever is your income, your expenses are exactly equal, means you are neither getting profit nor in the loss. Now the next one is the abbreviation BEP is stands for, just now I have repeated, that is nothing but the break even point. Now the next one is, in the long run, all the costs are, in the long run, all the costs are variable. Now the eighth one is, as the unit manufactured decreases, the variable cost per unit that remains constant. Now the next one is, at break even point, both profit and loss is, we have just now discussed about this, that is zero, because neither we are getting the profit nor in the loss. Next one is, profit divided by the PV ratio is, always remember that profit divided by the PE ratio, that is nothing but the BEP, that is your break even point. Now the next one is the last question of this PDF, that is, break even point in units is calculated by using the fixed cost divided by contribution per unit formula. So I hope that this is understood by all of you. So all the best for your examination. I'll try to upload more MCQs on my YouTube channel. Thank you so much.